This is crucial news for those investing in mutual funds. It reveals that 88% of large-cap mutual funds failed to outperform the index fund. In other words, if we had put our money into an index fund, we would have outdone the 88% of highly qualified professionals managing mutual funds. This same scenario occurred in 2023, where 3 out of 4 mutual funds couldn't outperform the index fund. We are all familiar with Warren Buffett's bet, where he stated that if any actively managed mutual fund surpasses the index fund over the next 10 years, he would pay $8 million. When this bet was placed between the index fund and 5 mutual funds, not a single actively managed mutual fund succeeded in beating the index fund. Therefore, the conclusion is clear. Just quietly invest in index funds. Why go for others? We also know that if we invest in a recurring deposit, RD, at around 7-8% for 20 years, the total value would amount to approximately Rs 18 crore. However, if we invest through a systematic investment plan, SIP, in an index fund at 12%, the value nearly doubles to Rs 2 crore. Now imagine what would happen if we managed to push that 12% to 16%. The amount would be almost 3 times that of RD. This extra 3-4% will make a huge difference over the long term. So the real question is, how do we move from 8% in RD to 12%? We know that this can be done via index funds, but how do we push it further from 12% to 16%? In short, how can we beat the index fund? Now, you might think, if highly qualified professionals can't beat the index fund, how can we? But the truth is, the index fund can be beaten, and the trick lies in utilizing the index fund itself. Before I explain the 3 methods to do this, we first need to understand how mutual funds invest our money. Picture it like this. If you start a SIP on the 3rd of a month, every 3rd, the mutual fund invests your money in the market. But not all 3 RDs are equal. For instance, on April 3rd, 2020, something significant was happening. The market was down. If you had invested during that time, your returns would have grown substantially over time. Had you invested Rs1 lock instead of Rs22,000, your returns would have been much higher. But how can we tell when the market is down? There are 3 strategies we can use. The first strategy is the RSI, Relative Strength Index. First, head over to the Trading Gate View website, search for the Nifty 50 Index, and set it to monthly since we're long-term investors. Next, go to the Indicator section and select RSI. The RSI chart will now show at the bottom of the screen. You'll need to adjust the settings. Typically, we get buy and sell signals between 30 and 70, but in this strategy, you only increase your SIP when the RSI value drops below 10. For example, if the RSI drops to 9.96, 9.33, or 8.71, you should increase your SIP for that month. The same situation occurred in June 2022 when the RSI value dropped to 9.33, and you could have increased your investment. In essence, when the market dips, invest more in the index fund to acquire more units and boost your average return from 12% to a higher figure. The second method is Warren Buffett's indicator. For this, go to the Guru Focus website to determine whether the market is overvalued or undervalued. According to Buffett's indicator, divide the market cap by GDP. If the ratio is below 64%, the market is very cheap, and you should invest extra in your SIP. If it's between 82% and 100%, the market is fairly valued, so continue with your normal SIP. If the ratio exceeds 100%, hold off on extra investments. Currently, according to this indicator, the market ratio is at 97.7%, meaning it's fairly valued. So you should continue with your regular SIP. The third method is the PE ratio. A high PE ratio indicates market optimism, whereas a lower PE ratio signals fear. According to Prime Investor, if the PE ratio falls between 14.6 and 21.8, the market is slightly undervalued, and you can invest extra. If the ratio exceeds 28.3, the market is overvalued, so you should stick to your usual SIP. In May 2024, the PE ratio was 21.61, suggesting the market was slightly undervalued, and you could consider investing a little more. However, here's where confusion arises. The 3 indicators are giving different signals. The PE ratio suggests the market is slightly undervalued. Warren Buffett's indicator implies fair value, and the RSI isn't giving a buy signal. So is this a dip or not? Investment data can often be unclear. When the data is ambiguous, it's usually better to consider it a no and refrain from investing extra unless 2 out of 3 indicators signal the market is undervalued. It's akin to buying a house valued at Rs1 crore when your budget is Rs80 lakhs. If the price drops to Rs90 lakhs, it's not enough of a reduction to buy. Wait for clearer data. Finally, how do we keep track of the market? One way is to set aside time each week to check these three indicators. Alternatively, you could opt for premium services like TradingView or Screener for real-time updates. I hope these three indicators will help you become a better investor. There are numerous books written on index funds and investing, so keep learning. See you in the next video.